Interest in HELOCs is surging, but will it last? And can they compete with a reverse mortgage? Welcome back to the Industry Leader Update. The number of HELOCs, or home equity lines of credit, originated surged 41% from the second quarter of 2021 to the second quarter of this year, according to a report from TransUnion. While year-to-year comparisons do give us some insight, the surge of home values that also peaked in June of this year and throughout that time period must not be forgotten. Also, interest rates, they remained at historic lows during that same time period. Earlier this month, the average rate for a HELOC jumped up 1.38% from late July to early August due to the Federal Reserve increasing its short-term interest rates. Now, despite the headwinds of softening home values and also increasing interest rates, several lenders have now expanded their product portfolio to include home equity loans, according to an August 1st column in Housing Wire. New entrants into the HELOC market include some heavy hitters, including Rocket Mortgage, the nation's largest lender. Then there's Loan Depot. They announced their plans to launch an all-digital HELOC in the fourth quarter of 2022. With purchase and cash-out refinance volumes tanking, lenders are moving quickly to find new sources of revenue, and HELOCs appear to be the popular choice. However, the future of HELOC originations is tenuous at best. Month-to-month housing market data is showing home values are dropping on average by 13.5% in a number of markets. And Fortune reports that housing inventory has spiked by 100% in 137 regional housing markets. Consequently, despite the present bullish outlook, HELOCs may not be an option for most homeowners by the end of this year or early next. Nevertheless, one thing is clear. Homeowner interest in extracting home equity is on the rise. The question remains as to how strong the desire to extract home equity would be amongst the age-eligible potential reverse mortgage borrower. And we're going to get to that in a minute. But the opportunity is certainly there. I think it speaks to consumer interest in using home equity for their cash flow across the age spectrum, as it continues to be the largest source of potential funds for most households, said John Lundy, the president of Reverse Market Insight, in a recent Reverse Mortgage Daily column. That was published last week. You can look that up. Also, there is still reluctance amongst the older homeowner to tap into their home equity, and we know that because Finance of America's Home Equity Survey, which was taken in early June, found that 94% of homeowners born between the years 1928 and 1945, they resist the idea of tapping into home equity. And 89% of baby boomers born between 1946 and 64 said they're unlikely to tap any home equity as well. But FAR's survey concluded 90% of respondents across all age groups would expect their financial advisor to recommend tapping home equity if that was appropriate. In other words, that reluctance is diminished considerably when home equity is coming from a trusted financial advisor or the recommendation to use it. So education is certainly needed. While the reverse industry, by and large, has focused our efforts on educating folks on the benefits of reverse mortgages in recent years, there is far more education needed, said Stephen Sless, who heads up the reverse mortgage division at Primary Residential Mortgage, in the recent Reverse Mortgage Daily article, particularly to those in the financial services industries and even to local bankers who are finding themselves talking to more potential reverse mortgage candidates, but often do not offer reverse mortgage products. In the final analysis, while HELOC availability is likely to fall off as the housing market continues to reset, HECM reverse mortgage loans will remain regardless. Where investors and lending institutions may choose to suspend HELOCs, older homeowners will find the home equity conversion mortgage as the more flexible choice that continues to offer favorable terms with no required principal and interest payments each month, and especially there's going to be no payment shock that you find in a HELOC at the end of a draw period. Also, unlike a HELOC, a HECM's line of credit cannot be frozen or even suspended when home values fall. HELOCs may be the popular choice for many homeowners, but it's a vulnerable choice, especially considering the loan's exposure to a volatile housing market. Now, what are your thoughts? Leave your comments in the comment section below. And also, if you'd share this video with others, we appreciate that. You can do that in your social media platforms. And be sure to hit like and subscribe to our YouTube channel. That way you never miss an upcoming episode. And each and every week, as I tell you all, if you have not listened to our recent podcast, you can do that. It comes out every Monday, HECM World Weekly, and Apple users can subscribe and listen on iTunes. That's it for us here. Thank you for joining us, and happy originating until we meet again next week for more reverse mortgage news, commentary, and analysis here at HECM World.